Welcome to the Deep Dive. We're your shortcut through complex information. Today, we're tackling a big one, trying to map the investment case for Apple Inc., that's ticker AAPL.
Yeah, getting your head around a company that size is,
Mm.
well, it's always a challenge.
Definitely. I mean, the scale is just immense.
It really is. For context, we're talking about a market cap right now around $3.78 trillion USD.
Yeah.
That puts it third globally, basically neck and neck with Microsoft.
Just staggering numbers. So our mission today is to cut through all that data. We want to pull out the essential insights from the latest financials, the strategy announcement.
Right, and we're focusing on maybe three key tension points.
Exactly. First, that classic Apple balance, hardware versus the super important services side. Second, this huge pivot they're making towards AI. It looks massive, potentially very costly too.
A really big strategic shift, yeah.
And third, the supply chain. It's shifting, and that's creating some financial drag. We need to look at that. Okay, now, before we dive in, the really crucial disclaimer. We have to be crystal clear here.
Always.
This analysis, it's purely informational. It's based only on the source materials we've reviewed. This is absolutely not financial advice.
Couldn't be clearer. We really encourage you, the listener, to do your own thorough research. Don't rely just on this.
Okay. With that very important note out of the way, let's talk foundations.
Yeah.
What's Apple's core advantage? Their moat, right?
It really comes down to that deeply integrated ecosystem. It's the hardware, the software, the services all working together seamlessly, usually.
That famous walled garden or ecosystem, it's not just marketing fluff, is it?
Oh, definitely not. It's a powerful financial engine.
Yeah.
And it creates, well, almost unparalleled customer loyalty.
You have numbers on that loyalty.
Yeah, the sources we looked at cite some pretty remarkable figures, like 98% loyalty for the iPhone in the US, 97% for Mac, 97% for Apple Watch.
Wow, 98%.
It's huge. That loyalty means high switching costs for customers. It basically locks them in and creates this massive, reliable, recurring revenue base.
And that structural advantage, you can see it feeding into the recent results, right? The June quarter looked pretty strong.
It did, yeah. A record June quarter, actually. Revenue hit $94.0 billion, which is up 10% year over year.
Solid growth and earnings.
Diluted EPS, $1.57. That's up 12% year over year. So good performance on both top and bottom lines.
Okay, so let's break down that revenue, that first tension point we mentioned, hardware versus services. How did that shake out in Q3?
Well, it's an interesting mix. Hardware is still the powerhouse, no question.
Yeah.
iPhone revenue, up 13%, hitting $44.6 billion. That was driven by the iPhone 16 models.
Okay.
And Mac revenue also saw a nice jump, 15% to $8.0 billion. That seems tied to the new M4 MacBook Air.
So strong hardware cycles there. But what about services? That's the higher margin segment everyone watches.
Exactly. And services delivered an all-time record, actually, $27.4 billion. That's also up 13% year over year.
All-time record. That's significant.
No, very. This recurring revenue, things of subscriptions, Apple Pay, warranties, all that, it's crucial because the profit margins are just much, much higher than selling, physical boxes.
Right. Higher quality revenue in a sense.
Precisely. But it wasn't all positive. Some segments did decline. iPad revenue was down 8%.
Okay.
And the wearables, home, and accessories segment dropped 9%. The company line on that was difficult comparisons to the previous year when they had some big launches.
Right. Tough comps. Happens. But even with those dips, the overall profitability picture seems pretty strong. Let's look beyond just the revenue, which, TTM revenue is huge, $408 billion plus. What ratios tell the story of Apple's health?
Well, the net profit margin is really impressive, 24.3%. That's quite high for a company selling so much hardware.
24% net margin is definitely strong.
But the number that really jumps out, I think, is the return on invested capital, ROIC. It's sitting at 47.6%.
Wait, 47.6% ROIC?
Yeah, 47.6%.
Yep, 47.6%.
Yep, 47.6%.
Yep. Honestly, that's phenomenal for a company this massive. How do they even achieve that kind of return?
It loops right back to that ecosystem, that customer stickiness we talked about.
Ah, okay.
The sources really emphasize this because they control the hardware, the software. That integration lets them maximize pricing power and minimize external dependencies. They're selling solutions, not just parts.
Integrated high-value solutions. That drives the efficiency.
Exactly. Keeps the operational edge sharp.
Yeah.
Keeps that ROIC incredibly high. But, and this is the key but,
There's always a but.
the market knows this, right? Which is why the stock trades at a premium. The TTM price-to-earnings ratio is currently 38.19. That's pricing in a lot of success.
Right. A PE of 38 means investors aren't just paying for today, they're betting heavily on future growth, which leads us perfectly into that second major point, the AI pivot.
Yeah, this feels like a really big deal. Apple's historically been, let's say, fiscally conservative, measured.
Right. Careful with big spending spikes.
But the language now is different. Tim Cook actually said the company is, and I quote, prepared to open its wallet to catch up in the AI race.
Open its wallet. That doesn't sound like typical Apple caution.
Not at all. And the commitment backs it up. We're talking $500 billion, $500 billion over the next 4 years.
Wow. Where's that $500 billion going?
It's earmarked for U.S. investments, things like advanced manufacturing, silicon engineering, designing their own chips, and crucially, AI infrastructure. This isn't just a small R&D bump.
Okay, $500 billion. Is that mostly about appeasing regulators, bringing manufacturing home, or is it truly about fighting the AI war?
I think it's both. But the core driver seems competitive. The sources suggest capital expenditures, CapEx, will grow substantially to make this happen.
So real spending increases are expected.
Yes. They simply can't afford to fall behind in AI if they want to keep that ecosystem advantage. They need their own integrated intelligence.
Which brings us to Apple Intelligence, right? That was the big reveal at WWDC 25.
Exactly. That's the first real product manifestation of this push.
So what's the key takeaway on Apple Intelligence for you listening?
I think it's the integration. It's not just another app. It's features like visual intelligence, photo cleanup, writing tools, all built natively into the operating systems, into the core apps.
So it feels seamless, part of the experience.
That's the goal, making it fundamentally change how you use the device, not just an add-on. And they're also working on a much more personalized Siri that's apparently slated for next year.
Okay. And presumably, this AI push is what drives the next hardware cycle. The new iPhones, the new watch.
Absolutely. The hardware is the delivery mechanism for the AI experiences. The new iPhone 17 Pro and Pro Max. They'll have the A19 Pro chip specifically designed for these AI tasks.
Custom silicon for AI.
Right. And the Apple Watch Series 11 sounds significant too. The focus is heavily on new health insights, which requires better processing, plus longer battery life and a thinner design. These products make the AI real for users.
They justify the huge silicon investment by becoming those essential AI access points. Makes sense. Okay, let's shift gears. The flip side. The costs, the headwinds.
Right, because it's not all smooth sailing.
We mentioned the supply chain shifts. That's having a real measurable impact, isn't it, on the bottom line?
It is. This is that second tension point we highlighted. Tariffs. There's immediate financial pressure here. The sources are projecting a $1.1 billion hit to gross margin just from tariff costs in the upcoming September quarter, Q4.
$1.1 billion just in one quarter.
Just in Q4. And that's up significantly from the $800 million impact they saw in Q3. So that headwind is growing.
That's real money coming straight off their margins. So how are they fighting back? What's the mitigation strategy?
It seems to be a multi-pronged approach. One, actively optimizing the supply chain, diversifying away from such heavy reliance on China.
We're seeing that diversification happen.
Yeah, the sources note a clear geographical shift. For the U.S. market, most iPhones are now coming from India, and things like Macs, iPads, watches are increasingly being sourced from Vietnam.
Interesting. India and Vietnam picking up slack.
Right. But products for other international markets, still largely coming from China, it seems. Alongside this, they're making those big U.S. investments we talked about, like the chip factory in Arizona. That helps reduce some geopolitical risk on key parts.
Okay, so diversification and U.S. investment. But that diversification takes time, it costs money upfront, and investors seem nervous about the near-term impact. The Q4 guidance wasn't exactly stellar, was it?
No, it showed a clear deceleration. They guided for mid to high single-digit revenue growth for Q4. That's definitely slower than the 10% growth they just posted for Q3.
And why the slowdown? What was the explanation?
Management pointed to a couple of things. Partly about a 1-point impact from what they called tariff-related demand pull-ahead, meaning some customers likely bought in Q3 to get ahead of potential Q4 price hikes due to tariffs.
Pulling demand forward. Okay.
And the other part was just difficult comparisons again. Apparently, there were strong iPad launches in the same quarter last year, making the year-over-year growth look tougher this time.
Right. So it highlights how sensitive they are to both policy, like tariffs, and just the timing of their product cycles.
Exactly. It's a complex dance.
And tariffs aren't the only external threat, are they? What other big risks should listeners maybe keep an eye on?
Well, the sources flagged a couple of major ones. First is purely competitive. The risk that some other powerful AI platform emerges, maybe one that bypasses Apple's hardware altogether.
So if AI lives somewhere else, the iPhone becomes less central.
Potentially, yeah. Diminishing its role as that main digital gateway. That's a long-term strategic risk. The second one is more immediate, regulatory risk.
Ugh, the regulators. Always circling.
Specifically around that deal with Google, the arrangement where Google pays Apple billions to be the default search engine in Safari.
Right, that's incredibly lucrative for Apple services.
Hugely lucrative. But it's under scrutiny. If a court ruling goes against them, that could seriously dent their high-margin services revenue stream. It's big uncertainty.
Yeah, that Google deal feels like a potential sort of Damocles hanging over them. Okay, let's pull this all together with the valuation picture. The stock's trading around, what, $254?
Around $254.43 USD, yeah.
Okay.
Now, the sources we analyzed put the estimated fair value quite a bit lower, actually, around $212.08.
$212, so well below the current price.
Right, and the overall sort of consensus target price in the source material was $240.45. So yeah, the stock is trading significantly above those estimates right now.
Which naturally leads to that split view among analysts, right? The bulls versus the bears.
Exactly, a clear divide.
So give us the core bull case. Why do some analysts see this going much higher, maybe targets above $300?
The bulls are really focused on that dominant, still expanding ecosystem. They see the $500 billion AI investment not as a cost, but as essential R&D, basically guaranteeing future relevance and earnings power.
An investment, not an expense.
Right. And they look at that services segment, growing fast, high margins, and see it as almost like an annuity. Predictable, recurring cash flow, maybe even resistant to some regulations.
Okay.
You have analysts like Dan Ives at Wedbush recently bumping his target up to $310. He's clearly betting big on the AI-driven iPhone 17 cycle being a huge success.
Okay, so ecosystem, AI investment success, and services strength. That's the bull view. What about the bears? Why do they argue it's overvalued?
The bears point to the immediate tangible problems. The rising tariff cost that $1.1 billion hit is real. The clear slowdown in the Q4 revenue guidance.
The deceleration, yeah.
And that persistent regulatory risk, especially around the Google deal. They argue that, look, maybe the AI future is bright, but a lot of that optimism, maybe all of it, is already baked into that high 38 PE ratio.
So price for perfection, leaving no room for error.
Pretty much. They'd say the risk-reward isn't compelling right now. And you see that reflected in the broader analyst consensus target over the last 6 months, which is around $232.38. Much more cautious.
Okay, so pulling it all together for you, the listener, what we have is this incredibly profitable giant, Apple,
Right.
with a really strong competitive moat, record services revenue coming in.
Mm-hmm.
And they've got these new AI-powered products lined up, designed to kick off the next big upgrade cycle.
Right. The potential upside is clear.
But securing that future demands this absolutely massive, unprecedented investment, that $500 billion AI and manufacturing push.
A huge bet.
And at the same time, they're facing very real, very immediate headwinds. Tariffs are biting into margins now. Regulatory threats are looming now.
Yeah, the costs and risks are definitely present tense.
So that brings us to the final thought, the question maybe you should ponder.
Okay, let's hear it.
Well, the experts should probably pose this one,
Good,
based
good.
on everything we discussed.
All right. Well, here's something to think about based on the material. Apple's committing $500 billion over 4 years to manufacturing, silicon, and AI. CapEx is expected to grow substantially.
Right. Big spending.
So the question is, how long will it actually take for those huge, unprecedented investments to show up in the bottom line? To generate enough earnings per share growth to really justify the premium valuation the stock commands today?
Good question. The cost is clear now. The payout is still a few years out.
Exactly. The cost is now, the big return is still essentially a 4-year wager. That's the core tension for investors, I think.
Present cost versus betting on future dominance. That really sums it up. Okay, that's our deep dive for today. Thank you so much for joining us and engaging with this analysis.
Yeah, thanks, everyone.
If you found this valuable, if you want more deep dives into the crucial topics shaping our world, please do take a second to subscribe to the channel. And hitting that bell icon, that really helps support our work and make sure you don't miss out.
Definitely help us keep doing these.
We appreciate your support. We'll see you next time on The Deep Dive.